We're going to go through the requirements under the new Code Section 199, capital A. We're going to define what qualified business income is and the computations therein. We're going to go through some limitations on what types of businesses would not be eligible. We're going to consider wage and capital limitations in the computation. We're going to go through the impact to shareholders and partners of pass-through entities that would be eligible for the qualified business income deduction. We're going to go through some important tax planning considerations. In addition, go through some state and local considerations as well. All right, qualified business income. Eligible for tax years beginning after 12/31/2017 and before January 1st, 2026. Individual taxpayers will be able to deduct 20% of all combined business income. It's not available for corporate taxpayers. The income has to be the domestic or U.S. source income, which would include Puerto Rico. The deduction is not allowed in computing adjusted gross income. It's taken after adjusted gross income. As we mentioned earlier, the deduction comes in to reduce taxable income is taken effectively below the line. Deduction is available to taxpayers whether they itemize or they don't itemize their deductions. The qualified business income deduction is not adjusted for alternative minimum tax purposes. The deduction only applies for income tax purposes, not a reduction for self-employment income tax purposes. The deduction is intended to effectively equalize the federal income tax rate for pass-through entity owners as compared to a C corporation. So, for example, if the top marginal rate is 37%, 20% of that amount yields an effective tax rate of 29.6%. So, Michael, that brings us to an interesting interplay here. We're at 29.6 for QBI income, and effectively the AMT top rate is 28%. And given the fact that the exemption's been doubled, there's no state and local deduction anymore, capped at $10,000. We should not put a lot of our clients in the alternative minimum tax position.
That's right. That's right.
All right. We have a slide that we're going to go through some of the entities and payment types that are going to be eligible, including sole proprietors, partnerships, S corporations, trusts and estates, certain REIT dividend payments, the portion of which is not qualified dividend or capital gain, qualified cooperative dividends, and qualified publicly traded partnership income. We've highlighted for you the items that the W-2 wage limitation would not apply to these items of income. The qualified business deduction is initially determined by analyzing each qualified trade or business type of income, gain, deduction with respect to the qualified trade or business, and it's not determined by entity type. Michael, as we know, there's exceptions to exceptions to exceptions. So here we're going to go through a couple of these exceptions, and then those exceptions being an item considered in determining net long-term capital gain or net long-term capital loss. Dividends, income equivalent to a dividend or payments in lieu of dividends, interest income other than which is properly allocated to a trade or business. Qualified items under this provision does include any item of gain, loss, properly allocated to such trade or business. For example, where we have a Section 1231 loss in relation to an abandonment of a leasehold improvement would qualify since it is part of the taxpayer's trade or business. If the net qualified business income from all qualified trades of business during the year is a net amount, the taxpayer is eligible for a 20% deduction of that amount. The limitation is based on 50% of wages paid or 25% of wages plus a 2.5% capital cost element, which would be considered in determining the qualified business income deduction. Now, with that, we are going to go into the computational aspects of how qualified business income deduction is determined. Michael?
Thank you, George. Well, this sounds great, this QBI deduction. We're getting a lot of questions on it, a lot of interest. So with that background, let's go through the computational part of it. And so first, we have to figure out what is the QBI for each trade or business. And that we're going to look at the lesser of 20% of the taxpayer's qualified business income. So we're going to determine that. What's the 20% of the business income? And then what is the greater of the following, A or B? A being 50% of W-2 wages with respect to the business, or 25% of the wages with respect to the business, plus a 2.5% unadjusted basis of qualified property. Now, note that it's unadjusted basis, meaning that depreciation is not counted in as part of this calculation. Once we determine the QBI for each trade or business, we then combine these amounts and have a combined QBI. Now, let's go to the second part of the computational aspect. Once the QBI, combined QBI is determined, we then compare it to the lesser of 1, combined qualified business income, or 20% of the excess of the taxpayer's taxable income over the sum of the net capital gain. Once we've determined that, we go to the third test. Third test is the result from the second test that we just discussed, plus the lesser of 1, 20% of qualified cooperative dividends, or 2, taxable income reduced by net capital gains. Now, a lot of our clients, George, as we know, don't have a lot of qualified cooperative dividends, so usually this part of the test is going to be 0, so it's usually going to be at whatever the amount is. The QBI deduction, maybe this QBI reduction need not exceed the taxpayer's taxable income, again, reduced by net capital gain. So what is net capital gains? Net capital gains is basically any capital gains as defined by Section 1H, and that includes Section 1231 gain from a qualified trade or business disposition.
All right, let's get into some examples, Michael, because let's say the rubber meets the road, right?
Yeah, exactly. All right, so we have a very successful construction contractor that operates in 3 businesses. 2 are in the construction industry, and the other is a self-rental real estate investment. Here are the facts. Taxpayers' taxable income is $7 million. We're going to reduce that by net capital gains of $1.5 million. Total adjusted taxable income is $5.5 million for this purposes. Now we're going to dig through each business that he invests in for QBI purposes. So General Contractors LLC, ownership of 33.33% in the construction industry, share of W-2 wages paid by that trade or business allocated to that contract is $1.2 million. Share of tangible property costs $300,000. Ordinary income of $5 million. Let's look at Repair Contractors LLC. 25% ownership. Share of W-2 wages paid by the trade or business $300,000. Share of tangible property costs is $120,000. Let's look at Rental Property LLC. 50% ownership interest. In most real estate investments, no wages are usually paid, so that's none. And share of tangible property costs is $85,000. Net rental loss of $300,000. So with that fact pattern, let's go through our first part of the test. So first, we're going to determine what is the general contractor's QBI at that level. We're going to take the lesser of 1 or 2. The qualified business income is $5 million, as we mentioned before, times 20%. That's $1 million. Then we compare that to the greater of A or B. A is 50% of the W-2 wages with respect to that business, $600,000, or 25% of the wages with respect to that business, $300,000, plus 2.5% of the unadjusted basis of qualified property. That's $7,500. Total is $307,500. Next slide, please. Then we look at Repair Contractors LLC. Same test. Qualified business income is $600,000 times 20%, $120,000. We compare that to the greater of A or B, 50% of the W-2 wages with respect to the business, $150,000, or 25% of W-2 wages with respect to that business, plus the 2.5% unadjusted basis, which is total of $78,000. Next slide. Determine the individual qualified business loss for Rental Real Estate LLC. Qualified business loss is $300,000 times 20%, that's $60,000. So now, let's summarize what we just read. As you can see, the QBI deduction for this trade or business is going to be $600,000 for general contractors LLC. That's the lower, the one of the 338. Then 120 for repaired contractors LLC, and rental real estate property LLC is $60,000. Now, let's determine the second part of the test. It's going to be the lesser of 1 or 2. The total combined QBI is $660,000, and we're going to compare that to 20% of the $5.5 million adjusted taxable income, which is 1.1. The lesser of 660. Then we compare that to the third test. 660 plus the lesser of A or B. Taxable income of $5.5 million, or 20% of qualified cooperative dividends. In this instance, that contractor did not have any qualified cooperative dividends, so 0. Total QBI deduction is $660,000.
Okay, so Michael, what if we have a taxpayer in this case that does have, for example, a qualified cooperative dividends of $100,000? What would be the impact to the computation?
Right. So in that instance, George, we're going to take the cooperative dividend of $100,000 multiplied by 20%. That's the lesser of the taxable income times 20%. So our QBI deduction would be increased effectively by $20,000. So we'll go from 660 to 680.
Very good.
If the net amount of the qualified business income from all qualified trades or businesses during the taxable year is a loss, it is a carried forward loss from a qualified trade or business to the taxable year. So you have to consider losses as well for QBI purposes. And let's go through an example. So similar fact pattern to as example 1, except assume that there is a carry forward of $1 million loss. That's $5 million times 20% for the 2018 tax year. Assume that the 2019 and 2020 tax years, QBI is the same as it was for the 2018 tax year, for example 1. So in 2018 tax year, general contractors had a $5 million loss. For QBI purposes, that's a negative $1 million. We're going to carry that $1 million loss forward to 2019. We're going to take $1 million against the $600,000 from general contractors, $120 from repair contractors LLC, and the negative $60,000 loss from rental repair LLC. Again, for the 2019 tax year, we have another loss of $340,000. For the 2020 tax year, we carry forward that $340,000 loss. Then we compare that to the income that comes through from general contractors, repairs, contractors LLC, and rental property LLC. Our total QBI is $320. The QBI deduction for 2020 is $320,000.
So the example that we wanted to illustrate is the sensitivity associated with that loss carry forward to effectively offset the qualified business income on a net basis.
Exactly. So there's a lot of tax planning that needs to be done for this part of consideration.
Right. All right, a couple other items we want to effectively articulate in terms of our computational considerations. Qualified business income does not include reasonable compensation paid to a greater than 2% shareholder of a business for services rendered, guaranteed payments to a partner for services rendered, and payments described under Internal Revenue Code Section 707A to a partner for services, for example, as an independent contractor. The exclusion for an S corporation, the impact of which is as follows. QBI specifically excludes reasonable compensation paid to a greater than 2% shareholder. While it would seem like an obvious reaction by a S corporation shareholder to reduce their W-2 wages in 2018, create more pass-through income, they still have to adhere to the reasonable compensation standards that we currently have in place today. A reasonable compensation is not an issue just for S corporations because of the flow-through income is not self-employment tax. As a result, an S corporation shareholder can be motivated to forego compensation in exchange for a larger distribution in order to save on payroll taxes. The IRS may reclass or recast a portion of those distributions back to wages to effectively estimate what a reasonable compensation amount would be paid and the corresponding payroll tax. What is the impact on partnerships? Well, with respect to qualified business income, which excludes guaranteed payments associated with partnerships and LLCs. This creates some ambiguity with respect to service-related partnership. For example, instances in which the underlying business is service-type organization. Partnerships do not have reasonable compensation requirement, unlike S corporations. Since partnerships are not allowed to pay wages to its partners, the partnership is not required to make guaranteed payments to its partners. Effectively, partnerships can voluntarily eliminate guaranteed payments and take 20% deduction on 100% of pass-through income. So that begs the question, Michael, what would this service do in way of potentially look to recast a guaranteed payment similar to reasonable comp standards that S corporations have to adhere to?
Yeah, let's see what Treasury comes out in terms of regulations. Okay.
All right, now, we've gone through a lot. Each part of this competition has subparts in terms of planning and limitations. With that, let's get into wage limitations.
All right, thank you, George. All right, so for QBI purposes, W-2 wages includes wages subject to wage withholding, elective deferrals, and deferred compensation paid by the qualified trade or business with respect to the employment of its employees during the calendar year, ending during the tax year of the taxpayer. In addition, amounts that are not properly included in the return filed by the Social Security Administration on the 60th day after the due date are also excluded. So you got two aspects you got to consider for QBI purposes for W-2. The W-2 limitation was put in place in order to prevent business owners from classifying their W-2 wages to 100% pass-through income to take advantage of the 20% deduction, as George just mentioned. The limitation is in place in order to avoid employees from leaving their company as a W-2 employee, starting a new sole proprietorship, and entering into a subcontractor relationship with their old employer, just to reclassify the W-2 wages into 100% pass-through income.
It does leave a lot of ambiguity, and certainly we're going to look for guidance because you can manage this process in a very advantageous way.
Yeah, definitely. All right, with that, let's look at some technical issues. Some of the questions that we just came up with, just reading Section 199A and some of the planning questions that we came up with. How will the reporting be done? In which trade or business? How will the reporting be done in which the trade or business is held in a pass-through entity? Will it be like what was reported in the former Section 199 deduction?
You would think so. I mean, so certainly, we're certainly waiting for all of us for guidance in terms of that. But we've seen the predecessor DPAD deduction, the domestic property activity deduction, where the flow through of all the related components from the S corporation and the partnerships would funnel down to the individual taxpayer level.
Yeah, I hope it becomes similar to that because now we know what to do. If the IRS does allow combination, how will the allocation of the C-suite team be done, i.e. the CFO and the related employee benefits? How will this allocation be done? How will the allocation be done between entities? If restructuring is the only possibility, what are some of the unintended consequences from an employment law standpoint, or even a pension plans? Workers' compensation insurance coverage is usually higher for employers with a significant number of new employees than employers with a high veteran employment staff.
So we got some issues there too. I mean, everybody looking to restructure their payroll have to make sure that is that the right result for the organization as a whole, or instead of a knee-jerk reaction to, maximizing this benefit, because there could be unintended consequences by virtue of that.
Yeah, trap of the unwary. So Treasury has been directed to issue regulations regarding how wages and adjusted basis of qualified property are determined in cases of a short tax year, or where the taxpayer acquires or disposes of a major portion of a trade or business in a separate unit of a trade or business during the tax year. So hopefully we're going to get some guidance on that sooner than later. All right. So there is also a wage limitation, but there is an exception to it for qualifying small taxpayers that can benefit from this. The wage limitation, 50% of the wages of 25 plus the tangible capital cost, does not apply for taxpayers with taxable income below a threshold amount of $315 for married individuals or $157,500 for other individuals, single individuals. There is a phase-out amount, which is $415 for married individuals. That's $315 plus $100,000, or $207,500 for single individuals, which is $157 plus the $50. With that, let's go through an example to understand this calculation better. Jack and Jill are a married couple. Jill has a qualified business, i.e. an architect, could be anything, which is not a specified service business. For the 2018 tax year, they filed a joint return reporting taxable income of $345,000. 20% of the QBI from Jill's business is 15, i.e. 75,000 times 20%. So the business generated 75,000, we're going to multiply by that 20%, 15,000 QBI deduction. But since Jill's income is above the 315, we have to look at it and see how much of that is needs to be adjusted. The wages paid by Jill's business is 20,000. Is 20,000. So 50% of the W-2 wage limitation is 10 grand. Assume that no qualified property factors into this calculation. The 15,000 QBI deduction is reduced by as follows. First, we're going to determine the difference between the QBI deduction and the W-2 limitation. So that's 15,000 minus 10,000, $5,000. So that's the difference between QBI deduction and W-2 limitation. Taxable income is 345, the 315 threshold. So we take the difference. The excess is 30,000. We're going to take the 30,000 excess, divide that by 100,000, because again, the phase out is between 315 and 415. That's 100,000. So the phase out range is a percentage. It's 30%. The excess limitation is 5,000. So 5,000 times 30% is 1,500. So the phase out amount is 1,500. So we're going to take the 15,000 QBI deduction minus 1,500, 13,500 is Jack and Jill's QBI deduction.
Thank you, Michael. So there is relief for small taxpayers in terms of being eligible for the deduction. We're going to turn our eyes now to the unadjusted basis of qualified property. Analysis of the 2.5% of unadjusted basis of qualified property, tangible property, which is used as part of a trade or business and is depreciable. Land would not qualify, subject to any further guidance. Further, to count as qualified property for purposes of qualified business income deduction, the property must be placed within the depreciable period for which has not ended before the taxable year. The depreciable period is the later of the following. A, the period beginning with the date of the qualified property's first place in service and ending on the later of the date that is 10 years of such date. For example, within 10 years of the current taxable year. Or the last day of the full year in which the applicable recovery period for the property, using the general depreciation system only. So, let's go into some of the examples that we put together, Michael.
Thank you, George. All right, so let's put this into a way that we can see how it plays out for a taxpayer that has some real estate in its portfolio. So assume the following partnership. It could be a partnership, could be an S corp, holds the following depreciable assets. Below would be the amount of the qualified property for the 2018 and 2019 tax year. So let's analyze this fixed asset schedule. There's land of $5 million, placed in service in 1997, and building of $25 million. So at the time, the land and building was acquired for $30 million in 1997. Land is not depreciable, so land would not be included as part of qualified property. Building was $25 million allocated to it, 39-year recovery life. No bonus was taken. So last year of depreciation would be 2037. It's not within the last 10 years when it was placed in service. So this example is 2018, 1997. That's greater than 10 years, but there is still an applicable recovery period because it's still being depreciated. So for the purposes of qualified property, we're going to include the $25 million. The leasehold improvement of $1.5 million, placed in service in 2004. Recovery life of 15 years. No bonus depreciation was taken in that year. The last year of recovery is 2020, so we're going to include the $1.5 million. Furniture and equipment. The amount, $500 and $250. Year placed in service was 2008. We took 100% bonus on the furniture. The last year of depreciation would be 2014. It was placed in service within the last 10 years because 2018, 2008 is within 10 years. But however, it's not being depreciated anymore because it's been fully written off. But since it does fit into one part of the test, we do include it as part of qualified property for the 2018 tax year. Equipment, we placed in service 2008, took 50% bonus. Within the last year, was placed in service in the last 10 years, so we do include that as part of this qualified property. The leasehold improvement of $1 million, for 2018, it could be a qualified improvement property, 15-year recovery life. We could take, this taxpayer would take 100% bonus if they planned it out effectively. The last year depreciation would have been 2034 if not taking bonus. Does it fit within the last 10 years? Yes. Applicable recovery period? Yes. So we do include the $1 million as part of this calculation. Total qualified properties, 28,250. Qualified properties times 2.5%, 706,250.
Right. So, excuse me. One of the things we got to be mindful of coming into 2017 and what we're doing in busy season is making sure that as we move into 2018 in terms of the capital on the fixed asset schedules or depreciation schedules, is making sure we don't write off assets that are placed in service that are fully depreciable, because that would be an unintended consequence whereby we would be reducing a potential QBI deduction for that given taxpayer.
Yes. Oh.
So let's continue on in some of the sensitivity examples that we have put together, Michael.
All right. Let's compare the 2018 result to 2019. You'll notice we got the same fact pattern, but the furniture and equipment, if you look at the test, it's no longer within the 10 years. So those two assets are going to be removed as qualified property. So the total qualified property is going to be reduced to $27,000,000. Effectively, our qualified property times 22.5% is going to be only $687,500. Now, just to draw some sensitivity to these examples, let's take an example in which the building was land and building was acquired in 1997 by 1982. So this is an older building. What would happen there? You'll see that the year placed in service is beyond the 10 years, of course, but the applicable recovery period is a no for the building. Why? Because it's already been fully depreciated. Last year depreciation was 2014. As you can see, $25 million, as the previous two examples had as qualified properties, no longer included. So effectively, our total qualified property is going to be reduced to $3,250,000. Times that by 2.5%, $81,250. And let's look further. So in 2019, you'll see that the furniture and equipment are no longer part of the schedule, no longer qualified properties. So it's reduced further to $2.5 million multiplied by 2.5%, $62,500. Now, we've given you guys these examples in order to illustrate how effective and how we have to keep track of our depreciable schedules going forward in order to plan out the QBI deduction.
Thank you, Michael. That was helpful. Let's get into some of the specified trades and businesses that would be eligible and effectively won't be eligible. Qualified business deduction is not available for certain specified trades of business. A specific service trade of business in any trade of business that involves the performance of service in the fields of accounting, actuarial sciences, athletics, brokerage services, consulting, financial services, health, law, or the performing arts. Involves the performance of services consisting of investing, investment management, trading or dealing in securities, partnership interests, or commodities. An additional caveat is for a principal asset that is a reputational skill of one or more of the employees or owners. There are exceptions. In the case of the architects and engineers are not specified trades of business for purposes of the qualified business income deduction. That's consistent with prior law, where architects and engineers were eligible for the old Section 199A domestic production activity deduction. So I could see where the architects and engineers effectively were carved out of this provision.
Yeah.
All right, let's get into some of the types of businesses and some of the computational impacts there.
All right, thank you, George. So, while the QBI deduction is not available for specified services, trade, or business, which George just mentioned before, a specified small service, trade, or business may claim a QBI deduction. So again, we go back to that exception to the exception rule. If the taxpayer's taxable income is less than the applicable limit, again, exception to the exception. So for joint filers, $415,000, that is $315,000, the threshold amount, plus the $100,000 phase out. For single filers, $207,500, which is $157,500 threshold amount, plus the $50,000 phase out. Same amount that we saw before for small taxpayers. Once a taxpayer is subject to the phase-out limitation, the QBI deductions reduce, and only a percentage of qualified items will be included as QBI. So let's go through an example to understand this a little better. John has taxable income of $187,500, of which $134,000 is attributable to an accounting as a sole proprietorship. Again, accounting is a specified service business. After paying wages including wages paid of $67,000 to his employees. John is a single taxpayer. Because his taxable income is less than $207,500, income threshold for specified services businesses, John can claim a QBI deduction, but only for an applicable percentage of his qualified items of income, gain, or deduction or loss, and the W-2 wages from his accounting business. Assume again that no qualified property factors into this calculation. So let's determine first what is the applicable percentage. So we take the $187,500, which is the amount for the specified service business. We're going to subtract $157,500, which is the threshold amount, 30,000 excess. So $187,500 is taxable income, excluding net capital gains. 30,000 is the excess amount when reduced by $157,500. 30,000 is the excess amount over 50,000. Again, he's a single taxpayer. His threshold amount is 50,000. So the phase-out percentage is 60%. Hence, 40% is the applicable percentage, meaning only 40% of the QBI and the wages are going to be included for the calculation. So QBI 134 times 40% is 53,600. The wage 67 times 40%, 26,800. Effectively, once he's within that threshold amount, his QBI component, the business qualified business income, and the wage component is going to be reduced. QBI deduction calculation. We're going to take the lesser of the following. One, the QBI deduction, 53,600 times 20%, which is 10,720, or the W-2 limitation, which is 26,800 times 50%, 13,400. John's going to take the lower of those two amounts, which is 10,720.
So not only do we have relief for small taxpayers, we also have relief for eligible service providers as well as being small taxpayers.
Right, and there's a lot of nuances when it comes to these calculations.
All right. While everybody rushed to go out and pay their property taxes and prepay their state income taxes, we need to take a look at the impact that state and local will have with respect to this deduction. The qualified business income is established to be a federal tax provision as stipulated by the Joint Committee Senate report. Further, most states use an adjusted gross income starting point to determine their state personal income in terms of the base. There are only 7 states that use a taxable income starting point. Those states are listed effectively below on this slide. We expect a lot of changes to state and local income taxes. We would propose that there probably will be some state add-back or decoupling or even modification as relates to the qualified business income deduction that could be determined as for state income tax purposes.
So effectively, it looks like that we need further guidance from the states.
And we see effectively out there, I mean, whether it be California, New York, Massachusetts, and other states who are effectively challenging a lot of the tax reform provisions, we will certainly keep our clients advised of further guidance as we receive it. One of the things that was codified as part of the qualified business income deduction specifically is a substantial understatement penalty. Any taxpayer who claims a qualified business deduction may be subject to a 20% accuracy-related penalty for substantial understatement of income tax if the understatement is greater than 5%, not the previous 10% threshold, of the tax required to be shown on the return for the year, or $5,000. So effectively, we need to take a special care in terms of the accuracy and make sure that, you know, as we determine that qualified business income deduction for our clients, that we're not in a position to have any potential manipulation of that particular deduction.
Yeah, 20% translates to a significant amount of penalty there.
All right. Some of the things we want to get into and closing as part of our presentation is other factors that, interplay with maximizing the benefit associated with qualified business income deduction. We certainly recommend you engage your Sax professional to develop the right plan to maximize these benefits available to you as a result of the new legislation, some of which will include what we discussed here with qualified business income, limitation on business interest of 30%, capital cost recovery changes on depreciation and the impact of bonus depreciation, the overall limitation of excess business losses, all of which effectively start in a funnel up top, Michael, right? We got QBI, we got the deduction on interest, we got excess loss limitations, we got depreciation impact, all of which kind of funnel down through to our clients and related taxpayers.
Yeah, George, I mean, this is not going to be one thing, one exclusive item. You have to consider everything combined, and the depreciation changes are going to be pressured. You want to take more deductions, more losses. That's going to translate to a lower QBI. That's going to translate to a bigger limitation on the deduction for the business interest. You got those rules there. Real estate professionals and those rules, I mean, they got a special set of rules where they can opt out. The excess business limitation loss of $500,000 for married couples, $250,000 for single. I mean, there's so much changes going on and so much interplay that you got to plan everything out together. Can't look at one component separately. Agreed.
All right. With that, we conclude our presentation for today. We want to certainly invite anyone for questions, and we certainly want to bring to everyone's attention the upcoming webinars that we have scheduled for March 1st, Interest, Expense, and Compensation and Benefits, and March 22nd, Cost Recovery and Depreciation.
Is the QBI deduction determined at the entity level or partner shareholder level?
Michael, what do you think about that one?
Well, that one's determined at the personal level, the QBI deduction, but again, a lot of it may need to be done at the entity level, especially when it comes to the deduction for the business interest limitation. That's at the entity level, but to answer your question, the QBI deductions are determined at the individual.
Had another one come in. Should I consider restructuring my business entity in terms of the compensation structure to effectively maximize QBI deduction?
All right. So what if we have a manufacturer distribution client who effectively was outsourcing their logistics and supply chain, and now in an effort to maybe maximize that process, want to in-source that as opposed to outsource, and they'll bring that effectively in-house, hire the employees to manage that process. Certainly that will have a bearing on the qualified business income deduction, the wage component, by virtue of that.
What impact does the bonus depreciation have in determining my QBI deduction?
Good question.
Well, bonus depreciation, since you're taking a larger amount of deduction, and if it's from a partnership or if it's done through an S corporation, it's going to reduce your taxable income, your traded business income. Effectively, that's going to reduce your QBI. You might even have a negative QBI, which is going to be carried forward to the following tax year. So you might get a benefit of having a lower taxable income, but that deduction is going to be also reduced. Now, note further that there is also an overall limitation of excess business losses that need to be considered. So if it's greater than $500,000 for the taxpayer, then any of the amounts over that amount would be carried forward indefinitely.
So effectively, we would have an additional carry forward to keep track of in terms of an attribute, Michael.
Exactly.
We have a QBI loss carry forward. We have an excess business loss carry forward. We got our net operating loss carry forwards. We got a passive activity loss carry forward. Foreign tax credit carry forwards. We can keep going. All right. With that, if there are no other questions, we'd like to thank everyone for viewing and attending our webinar, and certainly again invite you to attend future Sax webinars. Thank you.